Why did silver suddenly crash? That is the question stacking communities across Europe and North America are asking right now. Just weeks ago, silver was trading above $66 an ounce. Today, it has broken below 57. That is one of the sharpest pullbacks this metal has seen in over a decade, and almost nobody explained it to you properly. Most channels are either panicking or pretending nothing happened. Neither reaction is useful. What you are about to hear is the real mechanical explanation behind this move. Not fear, not hype, the actual forces driving silver lower and what they mean for your next decision. My name does not matter here. What matters is the data. So let's get into it. First, the headline number. Silver is now down more than 25% in the past month alone. It is trading at its lowest level since November of last year. But here is what almost nobody is talking about. Silver is still up over 50% compared to 12 months ago. This is not a collapse of the long-term silver story. This is a violent repricing inside a much bigger bull cycle. Understanding that distinction is the difference between panic selling and strategic positioning. So what actually triggered this drop? Three forces collided at the same time. The first is the United States dollar. The dollar index has surged to its highest level in more than a year. When the dollar strengthens, every commodity priced in dollars becomes more expensive for the rest of the world. That includes silver, European buyers, Asian buyers, Latin American buyers. All of them are now paying more in their local currency just to buy the same ounce. Demand cools, prices fall. This is exactly why smart money watches the dollar before it watches the metal itself. The second force is the Federal Reserve. New Fed Chair Kevin Warsh has taken a noticeably hawkish stance. Markets are now pricing in a real possibility of an interest rate hike as early as September. Just weeks ago, that probability was close to 30%. Now it has surged past 65%. Now pay close attention because this is where the story gets serious. Higher interest rates increase the opportunity cost of holding non-yielding assets like silver and gold. When yields rise, capital rotates out of metals and into bonds, into cash, into anything paying interest. That rotation is happening right now in real time across institutional trading desks. The third force is geopolitical. Progress in United States and Iran peace negotiations has pushed oil prices back toward pre-conflict levels. That sounds like good news. But for silver, it removed one of the strongest inflation hedging arguments that had been driving prices higher since February. Less war premium, less oil-driven inflation fear, less urgency to hedge. That urgency was a major pillar underneath silver's January surge to its all-time high near $121. Now, that pillar is weakening. This changes everything for silver investors who only understood half the story, but here is the part that matters most. None of these three forces address the actual physical supply and demand picture, and that picture has not changed. Silver remains in a structural deficit for multiple consecutive years now. Global silver demand has outpaced mine supply. Solar panel manufacturing alone now consumes a significant and growing share of annual global silver output. Add in electric vehicles, semiconductors, and medical technology, you have an industrial demand base that does not care what the Federal Reserve says about interest rates. This is the disconnect. Paper markets, futures, dollar strength, and rate expectations are driving the short-term price. Physical scarcity is driving the long-term trajectory. Those two forces are currently moving in opposite directions. That is exactly why this pullback looks dramatic on a chart, but tells a completely different story underneath the surface. So what happens next? Let's walk through the scenarios because this is where preparation actually matters. Scenario 1, the hawkish path. If Chair Warsh confirms a genuinely hawkish trajectory and a rate hike does land in September, expect continued pressure on silver in the near term. In this scenario, a retest of the $60 level or even a slide toward the mid-50s becomes realistic. This is the path most short-term traders fear. Scenario 2, the disinflation path. If core inflation continues cooling and recent readings have come in well below headline numbers, the Fed may be forced to soften its tone before September even arrives. In that environment, real yields compress, the dollar eases, and silver historically reacts fast and hard to the upside. Some institutional forecasts in this scenario put silver on a path back toward 80, 90, even triple digits over the following 12 to 18 months. Scenario 3, the geopolitical wildcard. Ceasefires are fragile. If tensions reignite in the Middle East, oil spikes again and the entire inflation hedge narrative comes roaring back overnight. This is exactly why smart money is moving early, rather than waiting for confirmation that may arrive too late to act on. Now here is what most retail investors get wrong during a drop like this. They watch the daily candle and react emotionally. Institutions watch the structural deficit and react strategically. The gold-to-silver ratio right now sits in the low 60s, meaning it takes roughly 60-something ounces of silver to buy a single ounce of gold. Historically, during active precious metals bull cycles, that ratio compresses significantly as silver outperforms gold. If that historical pattern repeats even partially, today's pullback may be remembered not as the end of silver's story, but as a pause inside it. What happens next could shock most investors who assume this correction confirms the bull market is over. History suggests sharp corrections inside structural bull markets are common, not unusual. They shake out short-term leverage, they reset sentiment, and they create entry conditions that did not exist when the metal was trading near its all-time high. That does not guarantee an immediate reversal. Risk remains real. A genuinely hawkish Fed combined with a stronger dollar for longer could extend this correction further than many expect. But ignoring the structural deficit underneath this market would be a mistake just as serious as ignoring the short-term pressure pushing prices down today. So where does that leave you? Silver is currently caught between two timeframes. The short-term timeframe is dictated by the dollar, by Fed policy, and by geopolitical headlines. That can shift overnight. The long-term timeframe is dictated by mine supply, industrial demand, and a deficit that has not been resolved. Smart positioning means respecting both timeframes at once, not gambling on a single headline, not abandoning the long-term thesis because of a difficult month. The metals market has always rewarded patience over panic and punished those who confuse short-term volatility with long-term direction. Whatever happens next with the Fed, with the dollar, or with geopolitics, the structural deficit underneath silver does not disappear with one hawkish meeting. That is the part of this story almost. Nobody is explaining to you clearly right now. And that is exactly why you need to stay ahead of this, rather than reacting after the next move has already happened. If this breakdown helped you understand what is actually happening underneath the headlines, make sure you are subscribed and have notifications turned on. This market is moving fast, and the next major shift could happen with very little warning. Comment the word silver below if you are watching this correction closely and preparing your next move. Comment the word gold if you believe the bigger opportunity right now sits with the yellow metal instead. Either way, stay close because the next several weeks could define the entire second half of this cycle.